What if I told you that the people who bought gold near the top, the ones now sitting on heavy losses, weren't dumb retail traders? They were professional hedge funds, managed money, the supposed smart money. And what if I told you that the people who shorted right at the top, the ones now sitting pretty with massive profits, weren't geniuses who predicted the drop? They were just doing their job, mechanically, without any idea where gold was actually headed. This is the real story of what happened in gold over the last 2 weeks. And by the end of this video, you're going to see this market, and every market, completely differently. Let's start with what we actually see on the chart. In early May, China comes back from Labor Day holiday. Shanghai Gold Exchange shows aggressive buying. Premiums spike. Gold rallies hard from around $4,530 up to $4,650. Then something interesting happens. Price stalls. For 5 days, gold ranges sideways between $4,680 and $4,720. Looks boring. Looks like consolidation before another leg higher. But underneath the surface, something completely different is happening. Open interest on CME is rising, steadily, day after day. New money is pouring into gold futures. The question every serious trader needs to ask is, whose money? Then, without warning, gold breaks. Hard. Drops over $200 in days. And now it sits in a tight range around 4,545, looking exhausted. What just happened? Who got hurt? Who got paid? And what comes next? The answer is in the data, specifically the COT report from the CFTC. The Commitment of Traders report breaks the market into groups. The two we care about are non-commercials. That's hedge funds, managed money, large speculators, and commercials. That's miners, refiners, banks, anyone hedging real physical gold. For the week ending May 12th, which captures that ranging period at the top, here's what the data shows. Non-commercial speculators added nearly 8,000 long contracts. They were buying aggressively at 4,700. At the exact same time, commercials added almost 11,000 short contracts. They were selling aggressively at 4,700. Read that again. Specs bought, commercials sold. Both heavily at the top. This is the smoking gun. The open interest didn't rise because shorts were piling on. It rose because funds were buying the China narrative while hedgers were selling into them. Specs going long, commercials going short, into the same range at the same time. This is called distribution. It's a textbook pattern that shows up before almost every major top in commodity markets. Now here's where most retail traders get it wrong. They look at this and say, the commercials are the smart money. They knew the top. We should follow them. But that's not what happened. The commercials didn't predict anything. They sold because their job is to hedge. A gold miner doesn't know if 4,700 is the top. They just know it's a great price to lock in revenue against next quarter's production. So they sell futures, automatically, mechanically. If gold had gone to 5,000, miners would have sold more there. If it had gone to 5,500, they'd have sold more there too. They looked like geniuses because their selling concentrates at high prices. But that's mechanics, not foresight. And the funds who bought at the top? They weren't dumb either. They were doing what they're built to do. Ride trends. Their models said price is going up. Add long exposure. That's a strategy that wins over hundreds of trades, even though it loses badly at turning points like this one. There is no smart money team. There's just a bunch of different players, each playing their own game for their own reasons. Sometimes their behavior creates the conditions for a reversal. That's all. So gold breaks. The macro shifts. Dollar firms, rate cut hopes fade. No fresh catalyst. The trend that brought the funds in dies. Now those late longs from 4,680 up to 4,720 are sitting on losses of roughly $150 to $180 per ounce. That's $15,000 to $18,000 of pain per contract. And here's the critical observation. They have not capitulated. Open interest stayed high through the entire drop. They didn't sell. They're holding, hoping for a bounce so they can scratch out at break even. JP Morgan flagged this exact dynamic in a research note. Managed money positioning has stagnated, not flushed. Translation? The bag holders are still bag holders. They're praying. This is the most important concept in order flow analysis. Trapped supply. Every single one of those trapped longs is a future seller, sitting at a specific price, waiting to dump. They're a wall of pending sell orders, hovering above the market. And until they're flushed out, that wall doesn't go away. So what's happening right now in this range around 4,545? Three groups are colliding. First, the trapped longs from the top, sitting still, hoping, not adding, not exiting. Second, fresh dip buyers entering on the China story, thinking gold has bottomed. Third, late shorts pressing the downtrend, betting on more downside. The commercials? They don't care. They're sitting comfortably with profits and unhedged production they can sell into any bounce. This is why the range feels indecisive. It is indecisive. It's three groups with three different theses fighting in the same price zone. Now, what does it take to break the deadlock? If price drops below 4,480, the trapped longs finally crack. You'll see open interest collapse as they liquidate. That's the capitulation flush, and it opens the door to 4,400 and potentially the 4,300s. If price reclaims 4,600 with falling open interest, that's shorts covering. Squeeze fuel. Targets jump back toward 4,680, where all that trapped supply is sitting and waiting to sell. Most likely outcome? More chop until one side breaks. Boring, frustrating, but normal. Here's where most traders get confused. They ask, if the trapped longs want to sell at break even and the shorts want to hold, how does price even get back up there in the first place? The answer is that order flow is sequential, not simultaneous. Different players act at different prices for different reasons. A rally back to 4,680 doesn't happen because the trapped longs make it happen. It happens because late shorts get stopped out on any bounce, and their forced buying drives price higher. Add in some dip buyer momentum, maybe a macro catalyst, and suddenly you're back at the trapped supply zone. And then the trapped longs flood the offers, desperate to exit at break even. The short covering buying is already exhausted. Fresh shorts join the commercials at the top. Supply overwhelms demand. Price gets smashed back down, often more violently than the first drop. This is why retests of distribution zones are so often violent rejections. The market remembers where supply lives. Here's the lesson most traders never learn. The market is not a puzzle with a hidden answer. There's no smart money team you can follow to get rich. There are just groups of participants, each doing their own job, each with their own incentives, each with their own time horizon. Your edge as a trader isn't predicting the future. It's reading structure. It's recognizing when positioning is crowded and vulnerable. It's identifying where trapped supply sits and how the market will move around it. The trader who shorts the top isn't a genius. They're a probability player who sized small, took an asymmetric bet, and happened to be right this time. They'll be wrong plenty of other times, and they're fine with that, because their edge plays out over hundreds of trades, not one. Stop looking for someone who knows the answer. Nobody knows. Start building probability maps instead. Where is the asymmetry? Where is the crowd wrong? What does each scenario look like, and how do I size for each one? That's the real game. Now, based on the macro and the fundamentals, what's happening with Iran and the US, the war tensions, the broader risk picture? Gold is going down for now. Specifically, the third week of May into June, we have selling pressure coming based on the statistics. So let me show you how to actually position around this. Imagine gold continues lower from here, and no fresh longs are coming in to defend it. What do? You look for shorts, and the best area to short is around 4,640 to 4,660. Why that zone? Because that is exactly where the trapped buyers are praying for price to come back so they can get out at break even. The moment price tags that area, those trapped longs flood the offers to escape. And that brings sell pressure, harder, faster, much lower prices. But what if price never makes it back up there? What if it just keeps falling from here? Then imagine what happens if gold makes another low. Cascading long liquidation. The ones who were praying for a bounce finally break. They puke their positions all at once, and price drops straight down. One big, sharp candle, no mercy. So get ready. Position yourself. Short this. That's how you need to read the market. This is just a little bit of how I see it. There are a lot of variables, a lot of moving pieces. But the most important thing is this. You need to change your mind. Stop trying to predict. Start reading structure, positioning, and where the pain lives. That's the edge. That's the game. And that's where the money is.